Welcome, listeners. You're listening to the Deeds in the Desert, where real estate investors tune in for the latest news.
Yo, what is up, everybody? My name is Ron. If you haven't seen me before, I'm probably going to be here for a bit. Today, we are on the new episode of Deeds in the Desert podcast, and as you can see, this is a hard-hatted event. Just kidding. Anyway, we got Pat in our in-person studio, and we got Tjaden out at Retcon. We're going to be talking to them today. They are part of our underwriting team. If you ever wondered what underwriting does or how we actually underwrite some of these, particularly in the trust deed investment ecosystem, we're going to get a good rundown of how they underwrite these loans. So let's start off with Pat. Pat, let's get into it. What do you do?
So when we deal with mortgages and we deal with trust deeds, the investments we offer and ultimately the collateral in which we are offering them through is more on a commercial side of things. When most people think about banks, think about lending, home loans, they're thinking more on the retail side of it. We are on the other side. We're dealing with big master plan projects, commercial projects, and although the underwriting, the documentation, and the disclosures is much of the same, the speed, ease, and convenience in which we lend enables us to lend to more business-oriented borrowers.
What is trust deed investing and how does it work?
Trust deed investing is a way for investors such as yourself to get involved in large-scale real estate projects at a small capital level, and you can choose what that level is. Say you want to enter at $10,000 or you want to enter at $1 million. We can do either. So how does trust deed investing work? Trust deed investing works as a form of debt instrument that obligates a borrower to repay the lender, which in this case is you as the investor, and obligates them to pay a certain interest rate throughout the life of the loan, and then obligates the borrower to repay that loan whenever the project is done or whenever we call them note due.
So, Pat, what would you say to a normal investor, maybe someone in the middle class? What should they be looking for in terms of loan to value?
So on average, here at Ignite Funding, we lend at about 68% loan to value. That number fluctuates depending on the stage of the project, depending on the location, depending on the borrower history, and a multitude of other factors. But all in, we're at about 68%. What that means to you as the everyday investor is the lower the loan to value, the better. The lower the loan to value means the more equity in the deal the borrower has. The more equity in the deal the borrower has means the less likely they are to default. If they're less likely to default, that means the risk level for the asset you're going into is decreased. All the while you're earning the same rate of return. So you get the same value, the same income, but lower your risk by a lower loan to value.
Let me ask you this real quickly. So for normal investors, how would they get started? How would they normally get started? What would they need to look for?
In a whole, underwriting is fairly simple. It is just risk mitigation. At the end of the day, we are a debt instrument, so we are earning a fixed rate of return. We don't get any upside, so we're not looking for home run deals per se. We're not looking for something to blow it out of the water and double their money. We don't do that. We have to worry about risk mitigation. So if a deal goes perfectly and goes well, the borrower earns or pays a fixed rate. Therefore, the investor earns a fixed rate. So what we need to mitigate against is the downside risk. What if the borrower can't perform? What if the asset can't be sold? What if it can be sold but not for enough money to recoup the investor funds? So that downside mitigation is what we solely focus on. That is where the art and science of underwriting comes into play. So when we underwrite, we look at exactly the same thing a borrower looks at. Our background is in real estate. Our background is on the acquisition side of real estate. So if we are out looking at, let's say, a raw piece of land, we're looking to buy a piece of land right down here in Las Vegas, right on the strip. We want to go and see what that property is worth. In order to do that, we need to see what issues it has, what's around it, what are the utility connections, how far away are they? Does it have capacity for it? So everything the borrower looks at, we also look at. So we want to know if we had to foreclose and own it, do we want to own this piece? If we are wanting to own the piece at the value that we're lending them, then it's probably a good loan. If we don't want to own it at that value, at that loan amount, we'll stay away from that loan.
What is the difference between a deed of trust versus a mortgage?
So a deed of trust and mortgage differ in one distinct and unique way, and that is they're both hypothecation instruments collateralizing a piece of asset, a piece of collateral, with a promissory note. Now that promissory note or that pledge is a promise to repay. Now how that instrument is actually recorded and held varies between a mortgage and deed of trust. For the average day investor, we kind of use the terms interchangeably. You know, we go out and get a mortgage for our house. Even though you may not actually have a mortgage, it's a deed of trust. We all use the term mortgage. And although we use it, we're not using it correctly. In that sense, it is a promise, a pledge of a piece of collateral, i.e. the asset, and a promise to repay, i.e. the loan amount. The promise to pay, the terms in which you have to pay, are recorded on the promissory note. That promissory note is an agreement between the borrower and lender. On a mortgage, the property is pledged through the borrower themselves. So they are saying, hey, I've got this house, I promise to repay you. If I don't, you can take this from me. On a deed of trust, the borrower says, I've got this house, I will borrow money from you, and I promise to repay, but instead of taking this from me, I'm going to hold this title into a third party, the trustee. This independent third party, the trustee, will hold on to the asset. They will give it back to me, the borrower, if I pay you off as the lender, and if I don't, they will give it to you, the lender, for my inability to repay. So because it's not held by the borrower and it's actually held in a third party, this trustee, it's a lot easier to take the property. As we all know, possession is 9/10 of the law. The difference between a mortgage and deed of trust is just that. Who actually owns that asset? Who holds it? In a mortgage, the borrower still holds on to title, still has all rights associated with it. In a deed of trust, that third-party trustee actually holds title to it and actually has the rights. So now I don't have to go take it from the borrower. I just have to prove to the trustee the borrower didn't perform, and they will give it to me. Because of that, I can do it outside of the judicial system, so I don't have to go through an attorney. I don't have to go through the court system. I can handle it through the trustee themselves. That in the state in which we lend, whatever state that is, has a very pre-described set of rules. As long as you follow those rules, you get the asset back. It's pretty much that simple.
So this one's for both of you, Tjaden and Pat. How does a first position really work? What's that process and what is it?
So, okay, I'm on a deed of trust. What does it mean to be in first position? Why is that better than second? Why is it better than third? Obviously, you know, first place is better than second place, but why? The real answer is during the foreclosure process. And it really talks into play of, okay, who's getting money first? During the foreclosure process, obviously you're going to have to pay taxes. The government comes first. But after that, there's something called a lien priority on every single asset in real estate that exists. When you operate in first position, you have priority over every single other debtor that is affiliated with the property. Say there's mechanics that have liens filed for work that they haven't been paid for. There's equity positions on the property. All of those are going to be below us as a first position note and a first position lender. What that means for you as the investor is, should we have to foreclose, you will receive your principal back before those guys sniff a penny. And that is obviously a great thing, because when you're in second and third position, say the asset doesn't cover everybody, it goes in priority. So it's very important to understand what position you're in, and then also understand, okay, what does this mean for me? So it's very important to keep all of that in mind.
A first lien position is a designation on a title report of who comes first. So really the old adage is first in line is first in priority. What that means is whoever got in line first, which means recording a deed of trust or recording a mortgage, has first priority. So if I'm a lender, you are a lender, we both are lending to the same borrower, whoever records their deed of trust first is in first position. Now that is an enormous caveat to it, which is there are some positions that are before us. Property taxes, CC&Rs, the HOA, rights of certain utility companies have a priority lien position over ours. But what will not have a lien position over ours is another financial institution. That is where the term first trustee comes into play, that first position.
Great stuff. What can borrowers expect from Ignite funding?
As far as the underwriting process goes and what a borrower can expect when working with Ignite funding, I say the biggest thing that a borrower can expect is we're easy to work with. A lot of traditional banks and other lenders have many layers of red tape, many deadlines to fund. It can take sometimes between 3 to 5 months to secure financing from a bank, and it can be rounds and rounds of due diligence and paperwork and a whole bunch of stuff that really just gives you brain damage. When you're working with Ignite funding, we're very clear, we're concise, we send one thing and that's it. And obviously we're gonna have a back and forth conversation, but we want to work with you. We want to make this process as easy as possible because we understand we're not cheap. We're not going to be the cheapest option. We like to consider ourselves expensive debt, but cheap equity, because that's what we are. We're someone that's going to partner with you on the project, and while we don't capture the upside, we want to see it succeed just as much as the borrower does. And we're going to be there every step of the way, should we fund this loan, to make sure that project succeeds.
That's pretty interesting. So for Tjaden and Pat, for people out there, what does the term due diligence mean?
Due diligence is obviously in the name. It's being thorough and checking off every single box to truly understand the borrower's company, what their track record is, what the project they're working on is, all of the ins and outs as far as cash flow with the project, what are their costs, what are their expenses, what are their hurdles to get to an exit strategy, what is their exit strategy, do they have room for not only one, but do they have multiple exit strategies? Say they're looking to sell it, but we also want to have the option to refinance it. Is our loan going to allow them to be able to do both and to pay us off in full by executing those strategies? All of those things are part of what is considered in due diligence. And another thing I forgot to mention, and well, really not forgot, but you saved the best for last, right, is you really want to understand, okay, we understand the borrower's company, we understand the project. Now, where does that fit into the greater scheme of the micro and macroeconomic state of the country? You know, is this going to be in a location that is a growing population? Are there people coming into this? Is there capital being invested in this area? Those are all indicators that we look for when we're underwriting a project. We want to know everything about it, and that's really what due diligence is. It's making sure investors like yourself, while we always want you to go and verify everything we say, that you can trust that we've done our work to say this is a strong investment opportunity.
The borrower should expect us to look at everything that they look at. If they went out and got a phase one, we'll probably need it. If they went out and got an impact study, we're probably going to need it too. If they went out and got a traffic study to figure out how many vehicles go by that property per day to see how much visibility there is, we're probably going to need that as well. So everything they look at, we're going to be looking at as well. Why that matters is we will look at it with them, and we won't go out and get a different opinion. We won't go out and get another traffic study, another appraisal, another impact study or soils report or any of that, but we'll rely on the work that they've already done and have it assigned over to us so we can have faith that it was done correctly and that all the I's are dotted and the T's are crossed.
So with all that in mind, Pat, during this window of time for new borrowers, for all the new people that are coming into this Ignite funding ecosystem, what makes it super special?
I wouldn't say it makes it more special, but it makes us a little bit more special. The reason I say that is a lot of investment firms like ours in this lending institution, the private lending world, they will rely on new investors coming in. So as they bring in new capital, they place it on deals, they collect revenue, they collect income from that, and then they will outsource the servicing. They will outsource the foreclosure. And if something goes wrong, they'll say, hey, sorry, we underwrote a good deal. You got to go take that up with the servicer. You got to go take that up with the foreclosure attorney. because we don't outsource anything, everything's done between these four walls, we take a lot of pride in what we do, and we want to lower that risk as much as possible. Because we've been able to do that, the investors stick around. And to your point, they stick around in this ecosystem that we've created. Because it's a one-stop shop, they can rely on us to do the underwriting. They can rely on us to do the servicing. They can rely on us to do the foreclosure. They can rely on us to do all the upfront due diligence to put them into a good deal and not just any deal. We see probably 100 deals a month. The investors see maybe 8 of those deals. So they're seeing the top 8% of what we see on a monthly basis. So they're not just seeing a deal, they're seeing the cream of the crop.
Nice. So to follow along with that, what have been some of the most recent successes that you've seen so far?
The success for us is a weighted topic. And the reason it is because we are on the debt side. So we don't get home run deals. We don't double our money overnight. And we don't want investors coming to us thinking that's going to happen, because it's simply not. What we are is a steady performer. We are a group that has been around during downturns, will be around during the next downturn, and will be around after the next downturn, which is the most important component. What we do is completely above board. We disclose everything to our investors. We show them what we're looking at and allow them to facilitate that transaction. If they want to get involved in it, great. If they don't, great as well. We'll have a different deal that they will feel comfortable with.
Why is Ignite Funding so unique in this industry?
It's unique because we do everything in-house. And the reason people tend not to do that is because they're more concerned about today's deal and not tomorrow's deal. We, on the other hand, take a more long-term vision. We're more worried about the next deal we do, because the longer that investor stays with us, the more likelihood they're going to add money, the more likelihood that they're going to tell their family and friends about us, and we just grow organically. Because of that, we want to control the narrative. We want to control what is being said, what is being disclosed, what is being advertised. In order to do that, we do everything in-house. The underwriting, the funding, the servicing, and foreclosure is all being done here. We don't want to pass your money off to somebody else and say, don't worry, they'll take a good care of you. We want to make sure we do it because it's our reputation at the line. If an investor loses capital, they don't care whose fault it is. They look at us as Ignite Funding, that it was our fault, we should have done something differently. And because of that, we want to make sure we do everything we possibly can to ensure that doesn't happen.
All right, so for all the investors, Pat, how can they start investing in trust deeds?
The best way to start investing in trust deeds is to learn about it. Most of the time, this is the first time an investor's heard about it. It sounds like it's too out there, too different, and some people have a completely different train of thought, and it's too good to be true. How can you be collateralized with real estate, just like my deed of trust and my mortgages on my house, but I'm earning double what I'm paying the bank? How can you do that? It seems too good to be true. Well, I would say look into it. Don't just rely on Ignite Funding and Ignite Funding site. Read around, talk around, think about it, and really do your own due diligence.
Cool. So we're about to wrap it up now. Thank you to Tjaden and Pat. We appreciate your time here. You got any final words, either of you, to say to the community?
We have a large track record of success. I think something you can point to there is our default rate. We've funded over $2.1 billion worth of loans, and our default rate is just under 4%. That equates to about 44 deals out of around 1,400 to 1,500 deals we have that have gone into default. And of those deals that have gone into default, as a total amount, we have lost 0.04% of our capital. That is, in my opinion, a very strong number. As far as successes so far, I could point to many deals. Many of our investors may know the KB Ashfork deal. While that deal has not paid off yet, it has been performing well and is moving towards a sale. We've been talking with the buyer and is crushing it. Another great example of a success so far is, it's really hard to pick one. Every loan that pays off is a success in our book.
before investors start investing here at Ignite Funding, I would highly recommend them getting acquainted with the risks and returns of this type of investment. Don't rely on just Ignite Funding. Do your own due diligence. Look online, talk to family, talk to friends, see who has been invested in this product before. Make sure you are comfortable with the risks as well as the returns associated with this type of investment. Once you become comfortable with that and become comfortable with what many other high net worth individuals are investing in, this type of product, then the best way to get started is going to our website, clicking on Get Started Now, and become an investor. Once you sign up and create an account, you will start seeing the deals. You will start seeing the products that we offer, and you can wait on the sidelines until you find one that is a home run to you. Best way to do that, go into the website right now.
Go to ignitefunding.com and get started today.
All right, we want to say thanks to Tjaden and Pat for being a part of this Deeds in the Desert podcast. Now, if you haven't yet, please like, comment, and subscribe to the channel and show us some love. This is the only way we know to give you more of the stuff that you want. So comment, like, share it with your friends, share it with your family, share it with who you want. Tjaden and Pat, thank you so much again, and we'll see you on the next Deeds in the Desert podcast.
Thanks for joining us this week on Deeds in the Desert, where short-term investments meet long-term investors. We hope you enjoyed the content so much that you share it with all your friends. Who doesn't like learning about passive fixed income, right? Still hungry for more education? Visit our website at ignitefunding.com. Or if you're ready to take the leap and start investing, give us a call at 702-761-0000 and schedule a free investor consultation.